So another question I get a lot is about the non-cancelable feature of a contract. And really there's kind of two camps. There's the non-can policy, and then there's one that we refer to as GR, or Guaranteed Renewable. Now it's not an either or type of scenario, because all non-can policies also encompass this guaranteed renewability in the contract as well. So the GR, let's start there. The GR means that there is going to be a provision in the policy that guarantees that the policy is going to renew every year you pay the premium. In other words, the carrier just can't cancel the contract whenever they want. If you're paying the premium, it's guaranteed to renew, and usually until age 67, age 65, somewhere way up there. So that's how the GR function works. Now, the non-cancelable policy kind of insinuates that if you don't buy this, the carrier could cancel. That's not true. What it protects you against is the carrier's potential for rate increases down the road. So with the non-can rider or non-can policy feature, you're looking at a policy that essentially has guaranteed level rates for the life of the contract. Now, a lot of people like that idea, that stability, that the guarantees that are inherent in that type of definition. But a lot of people also like to ask about, well, what's the history of rate increases? And in the DI world, there haven't been that many lately. I mean, a ton of them were really occurring in the 80s and 90s, which is where you saw the invention of this non-can feature, especially on a wide scale. I mean, virtually all policies for a time were all issued with the non-can rider. They baked in the extra cost in these premiums. And now carriers are starting to walk that back a little bit. So you can buy just a GR policy without the non-can provision and save 10 to 20% in some cases. And so, the question is, I've heard one client pose it this way: why would I prepay for a rate increase that may or may not happen? And if it does happen, would it be more than 10 to 20%? It's a good question, and it really depends on the budget and the client's risk tolerance. So we do a fair share of GR policies, guaranteed renewable policies, without the non-can rider. Some people like to make sure they're getting the best of the best, and they want the non-can on there. They want to make sure that these premiums are never going up. And these are fundamentally different than some policies that you'll see in the marketplace that are guaranteed to go up. They have an increasing level of premium. And the idea behind that is they want people to buy when they're young, and then by the time they reach 40, 45, 50, they're priced out of the new market, and they're kind of stuck paying those really high premiums, which can be some 1.5 to 3 times the amount that it would have been to get a GR policy, assuming no rate increases on the GR plan. So something to think about. That's where we stand on the GR versus non-can.